So we are starting with new subject today. Name of the subject is equity investments. Now the same subject at CFA Level 2 will be called equity valuation. So you can understand why the name of the subject changes slightly. At level 1, there is not much of an emphasis on how to value that equity share. So we do have one particular reading on equity valuation, but that is again on a very superficial level. So at level 1, the larger focus is on understanding the structure of the financial markets, which means there would be a large chunk of theory that we would be looking at. So typically about 70% of the area of equity investments is theory, and roughly 30% of the area will involve numbers and number crunching. Now, first point of discussion, what are the main functions of the financial system? Okay, so in fact, can anyone tell me what is a financial system? Investors to borrowers. Organized system which enables flow of funds from investors to borrowers, absolutely. So, can you guess what would be the functions of this financial system? Capital allocation, absolutely. Yes, so the whole idea of financial system, and you can think of this financial system as a mix of equity plus debt plus real estate plus all other alternative investments market. That means why do we have financial market? So we know that on one side there are set of investors who have excess amount of money to be parked in, and on the other side there are set of businesses who can put that money to the most efficient use. The job of this financial system is to ensure that this money reaches from investors to business at an appropriate rate in the most efficient manner possible. Are we fine here? So let's look at those 3 points. 3 main functions. Number 1, allow entities to save, borrow, issue equity capital, manage risk and exchange assets, and utilize information. That's point number 1. To determine the return that equates aggregate saving and borrowing. Can you tell me what this means? Point number 2. Determine the return that equates aggregate savings and borrowings. Correct. So what he's essentially saying is that the interest rate that we see in the market is a function of demand and supply, isn't it? Imagine a scenario where one fine day all of us realize the need for loans and all of us start going to the banks asking for loans, and we stop making deposits. Then suddenly that demand for money will increase tremendously, and then there is a possibility that interest rate will also start increasing. Right? So what this says is create a system in such a way that equilibrium of demand and supply for money works well. And third point, allocate capital efficiently. What would this mean? That means capital should reach to the most efficient businesses in the most efficient cost structure. Let's move on. Let's try to solve this question. Least likely. Correct. This is not the function of financial system. Are we good to go ahead? Classification of assets and different markets. So I have one big flowchart here. You need not write this, but just understand. First one, financial assets versus real assets. What would be the difference? Financial assets versus real assets. Yeah, so if you invest into, let's say, a commodity, maybe you buy some physical gold, that's a real asset. But if you buy share of a company which is doing business in gold, let's say you buy shares of Tanishq, then it would be a financial asset. Are we fine? Then public versus private. Public means the securities which are available on exchanges. Private means if you buy shares of FinTree, then it would be a private investment. Debt versus equity. I'm sure you understand the difference. Tell me what would be the difference between money market and capital market? Yes, money market are short-term instruments. Now one important thing you might want to write down is, so write down in your notes, money market will have original maturity less than 1 year, and double underline the word original. Money market instruments, original maturity less than 1 year. So what does it mean? If a instrument is recently issued and its total maturity is less than a year, then it is a money market instrument. But how about a T-bond, a treasury bond, which was issued 20 years ago, or let's say 19 and a half years ago, with a total maturity of 20 years? That means remaining maturity of 6 months. That would not be considered as a part of money market. Are we clear? Only those instruments which have an original maturity of less than 1 year are part of your money market. Spot versus future. What is this? Spot means you want to buy the asset right now. Future means you make a commitment that I will buy the asset at a pre-specified rate in future. Traditional versus alternative. Stocks, bonds are typically part of traditional investments, and real estate, commodities, hedge funds, private equity, all these are part of alternative investments. Primary versus secondary market. Yes, you buy shares in IPO, that's primary market. But once the shares are issued and they are listed on exchange, you buy it there, then that would be a secondary market. Any questions you want to ask on this slide? Should we? Since it is listed, we are going to call this as public security. Excludes commodities. Distinguishing characteristics and major subtypes of securities, currency contracts, commodities, and real assets trade in organized markets. So these are the major category of assets: security, currency, contract, commodities, and real estate. Securities we will further classify into fixed income, equity, pooled investment vehicles. Fixed income means bond market related instruments. Equity would be, of course, equity shares or common stock. And what would be pooled investment vehicles? Yes, mutual fund, where investors would collectively make an investment. Investors would collectively make an investment, and then that investment in turn would be invested into certain financial assets. So let's look at subtypes carefully. Fixed income will typically, these are few of the examples. They will include bonds, they will include notes. What is the difference? Difference between bonds and notes? Yes, not short term but medium term instruments. Okay, so US Treasury issues three category of securities. It issues T-bills. T-bills are typically less than 1 year of maturity, zero coupon instruments. It issues T-notes, which are typically 5 and 10 years, and then it issues treasury bonds, which are longer term maturity. And what are commercial papers? Yes, short term instruments issued by companies. Again, these are typically into zero coupon category. Do you understand zero coupon? Okay. Equity will have common stock, preferred stock, and warrants. What would be warrants? Mm-hmm.
They are like shares having free transfer.
Yes, they are negotiable instruments. They are in a way like options. They will give you right to buy shares of a company, but these can be transferred from one person to another simply by delivery of that instrument. Right? That's why they are called freely negotiable. And then pooled investment vehicles, mutual fund, ETFs, and hedge funds. Are we good to go ahead? Currencies. Currencies can be traded into spot markets or into forward markets. Do you understand the difference of both of these? Contracts. So contracts, we have all types of derivatives. We've had some discussion on them at level 0. Futures, forwards, options, and swaps. We again have a subject, so that time we can go more in depth. Commodities. Commodities can be traded in spot or in future or in forward markets. And what kind of commodities could be underlying here? We can have agriculture commodities or industrial or precious metals, or we can have energy related products. And then real assets. Now real assets again, what are possibility? Either you can actually buy a real estate, okay, which is called as a equity investment in real estate. Equity investment in real estate means that there is a, let's say, a piece of land that needs to be purchased. The land is worth 100. Now typically when you're buying a real estate directly, there is a possibility of leveraging. That means possibility of taking some loan and buying that real estate. So if you decide to invest your own 30 and 70 is taken as loan, so then this 30 is called equity investment in real estate. Is that fine? Another option through which you can take exposure to real estate is instruments like REIT. What are REITs? Real Estate Investment Trust. So you can think of REITs as similar to mutual funds, where you would invest into an REIT scheme and in turn those REITs would invest into real estate. Are we good to go ahead now? B is correct.